So the literature on corporate taxes, it's fundamentally focused obviously on firms rather than individuals, which is what we spend most of this class talking about, and that's what a lot of public and labor economics research has focused on recently. And the corporate tax literature, honestly, is it's less active than it should be. We haven't taught it here for many years, but I think there are a number of interesting questions, and just from a practical market sort of point of view, there's great demand for corporate finance and corporate tax sort of work, partly because there's the types of methods we've been talking about of quasi-experimental techniques, sufficient statistic approaches, and things like that have not really penetrated this literature as much. So you'll see that in what I teach here, because in some of the other sections, a lot of the papers we've been discussing are all from within the past 2 or 3 years. Here, a number of the papers are going to be from the 1980s because people really have not done a whole lot within the past 10 or 20 years. So to start with just a very crude overview, what does a firm do? It takes money from investors, so it takes money from people, makes some investment or production decisions, and then ultimately the reason people are giving the money to the firm is because the firm is going to return the money back to the investors, right? So steps 1 and 3 are financial choices, where you're figuring out how you're going to raise money from investors. Are you going to use debt? Are you going to use equity? How are you going to structure things? And step 3, how are you going to pay the money back to people? Are you going to use dividends? Are you going to repurchase shares and so on? How much are you going to pay back and when are you going to pay it back? Step 2 is, we think of as a real economic decision, and arguably is what we care about ultimately for efficiency, right? So you'll see a discussion in this literature about real decisions versus financial decisions. And the idea is that, there's a whole literature obviously and a whole field focused on finance by itself and thinking about finance. But as economists, often we care about finance because it has an impact on real behavior, which ultimately affects efficiency and growth and so on. Okay, so thinking about corporate finance. So why do we end up focusing so much on corporate finance in the tax literature? Because taxes are levied on financial payoffs and on financial structures, right? We have things like the investment tax credit, which are directly about investing, but mostly corporate tax policy depends upon financial structure. So there's a tax rate on dividend payments, there's a tax rate on profits earned, there's a different tax treatment of debt and equity. And so you need to understand corporate finance in order to understand how taxes work. So there's a good handbook summary by Auerbach in 2001, which I'll follow fairly closely. And as I was saying, the way this handbook chapter is broken down, which I think is useful, is basically firms make 2 sets of financial choices, right? How do you raise money? So what's the basic decision there? Do you use debt, where, like, let's say I'm trying to raise $100,000 to invest. So the structure of debt would be, you give me $100,000 and I promise to give you $105,000 back no matter what happens, except if I'm not able to pay the money back and I don't have enough profits, then I default on that commitment, right? So debt is fixed payments to investors, versus equity, where I give you, say, 1/3 of the shares in my firm, and whatever profits I get, you get 1/3 of it, right? So stochastic payments to investors that depend upon profits. So these are 2 different ways of financing firms, and they're potentially going to be affected by tax policy. The second question is, now you've raised some money, you've made some profits. How do you return the money back to the investors? So in the case of debt, there really isn't a choice. You just make interest payments back to the investors. In the case of equity, there is a choice, which is that you can pay dividends. So each share owner gets X dollars each quarter or something like that, because he's a shareholder of Microsoft, say. Or you can buy back shares. So you can basically, a bunch of people own shares of Microsoft. Microsoft can buy a bunch of those shares, which is effectively putting cash out of the firm, right, in a different way. And dividends are going to be subject to dividend taxation, repurchases, because they're going to effectively raise the price of the share. they are going to be subject to capital gains taxation. Okay? And then in addition to deciding whether to pay back dividends or repurchases, there's always a decision if the firm is going to continue for the next period, how much does Microsoft choose to keep within the firm, and how much does it choose to pay out to investors? So the decision of how much to retain. All right? Now, a useful benchmark in this literature in thinking about how corporate finance affects investment, so this debt equity decision and so on, how does that affect investment decisions and the value of the firm? The place people usually start in the modern literature is Modigliani and Miller's famous 1977 Nobel Prize winning paper, where they make a very strong point, which is that corporate finance is actually totally irrelevant for firm values and real behavior in a model where you have perfect markets and no taxes. So let me give you an example of this theorem that's very easy to understand. Okay, so let's say you've got two companies, Ford and GM, that both generate the same stream of profits. Okay, so these companies, they both do identical things and they're going to produce the same stream of profits in future years. But they have different financial structures. Let's say Ford is financed entirely by equity. So the way they raise money is give people a bunch of shares, people invested in them. And let's say that equity is worth $1 million. GM, what they decided to do is borrow $250,000 from, so they have $250,000 worth of bondholders, and the rest is financed by equity. Okay? So what is the value of shares in GM? Well, we know because of a no arbitrage condition that the value of the shares in GM has to be $750,000. And why do we know that? So a lot of corporate finance, the way we think about it, is replicating assets. So I can replicate the payoff stream that I'd get from buying all the shares of GM by buying all the shares of Ford and borrowing $250,000, right? That would put me in exactly the same position. And so what should I be willing to pay in order to do that? So buying Ford and borrowing $250,000, that I should be willing to pay $750,000 for the GM shares, right? It's equivalent. So given that the debt is worth $250,000, that tells you that the total value of GM and the value of Ford are the same, irrespective of the fact that they have different financial structures, right? So what's the intuition here? It's very simple. When you're buying a firm, what you're buying is access to its stream of future profits. It doesn't matter what particular financial structure that firm had. At the end of the day, you're buying the real stream of payoffs, right? And so that tells you that finance per se doesn't matter for what a firm is worth or what a firm should do optimally, okay? So that's what's called capital structure irrelevance. You don't need to worry about corporate finance in the standard model. So the way to think about this is like a benchmark, like the first welfare theorem. We don't actually think this is true. There's a great deal of attention paid to corporate finance, but it helps you think about why corporate finance matters, right? And so in particular, taxes are going to create a difference between debt and equity, for instance, or dividend payouts versus share repurchases. And as we'll see, that's going to potentially lead to real effects of these financial decisions. More generally, independent of taxes, as soon as you have, if you take a corporate finance class, we'll talk a lot about this, as soon as you have things like asymmetric information, where the managers of the firm know more about what's going on than the shareholders, which is quite realistic, then debt and equity become very different, and the way you're financing the firm can end up affecting the risks that the managers take and so forth. Okay? So we are going to focus here not on the broader issues of why corporate finance matters, but specifically the effect of taxes on finance and the consequences for investment. And we're going to do that in 3 steps. So first, I'm going to start by talking about payout taxes. And there's a lot of focus, especially on dividend taxation and corporate profits taxation. We'll think about how that affects payout decisions and investment behavior. So that's kind of like step 3 in the logic that I was showing before. Then we'll go back to the first part and think about how taxes affect financing choices up front, choosing debt versus equity. And then we'll talk about organizational form choices, like do you organize yourself as a corporation versus a partnership versus various other things, all of which have different tax consequences. So we start with a very simple model of firm behavior, which is a stripped down version of along the lines of what Auerbach has in his handbook chapter, similar to what Paterba, Summers, Feldstein, various others in the 80s were working on. I think a simpler exposition of all this is in this AEJ paper that Emmanuel and I have in 2010, which is on an agency theory of dividend taxes. That's not what I'm going to talk about in the beginning, but our model nests these earlier models. Okay. So here's how it works. You've got a firm that has cash holdings of X at t equals 0. So think of a firm, we're starting to look at it at a point where they've already done something in the past that's generated some profits, and they have some retained earnings. So Microsoft is sitting on $60 billion of cash or something, right? So it describes a firm like that. Now this firm can raise more funds if they want to by issuing equity, which I'm going to call E. So I have a public offering of shares, and I can raise money from investors like Twitter is going to do now, right, with the IPO. And so the total cash holdings then are going to be X plus E. The firm's manager chooses a level of investment I, which is going to have a concave payoff F of I in the next period. And F of I denotes the gross payoff. So if I invest $10 and that generates, that I end up having $15 in the next period, capital F of I denotes the $15. And net profits are going to be 15 minus 10, $5, which I'm going to denote by little f of I. Now, in period 0, I invest a certain amount, and I pay out the remaining amount, x plus e minus I, as a dividend. Now, that actually matters because I'm going to rule out the possibility that you can buy back shares that investors might have had. And we'll talk about this later, but share repurchases actually are tax preferred relative to dividends. So there's a literature on why any firms are paying dividends at all. Why don't they just buy back shares instead? Okay. But for now, just assume you cannot repurchase shares, so you only have dividends. There's a tax tau d levied on dividend payments in all periods. And there's a tax tau c levied on corporate profits. And investors can also purchase a government bond that I'm going to assume pays a fixed rate of R. So I'm going to cut out any general equilibrium effects through which these taxes might end up affecting the interest rate on the government bond. So think of the government bond as an infinitely elastic supply and has a fixed interest rate that's unaffected by the tax rates. So what is the objective function of the agent here? So in the neoclassical model, managers are modeled as maximizing profits. So they're acting on the behalf of shareholders and trying to maximize the value of the firm. So what is the value of the firm? It's important to understand this well because this is where everything's going to come from. So the value of the firm is the present value of the stream of payments investors receive, right? The present value of dividend payments. In the first period, the firm is paying a dividend of D, and you end up as the investor getting 1 minus tau D times D. So that's the first period payoff. And you are giving the firm, if it's raising equity, shareholders are putting in E dollars, so there's a minus E there. In the second period, we're going to discount all the flows by 1 plus R to bring them back to present value. And so let's start from the inside of this bracket here. So there's a payoff from the investment that you make. How much do you invest? You invest X plus E minus D, right? And that has a net profit of little f of that, okay? And the corporate profits tax is levied on your net earnings, right? So if I invest $10 and make $15, I pay the corporate profits tax on the 5, not on the 15. That's why you've got little f multiplying 1 minus TC, not big F. Okay, now I also give you your $10 back, so that's the plus X minus D. And the way it works under US tax law is all of this stuff is paid out as a dividend, but the initial equity that you put in when you pay investors back on their initial equity investment, that's not considered a dividend and is not subject to dividend taxation in the US. So that's why the E is not multiplied by the 1 minus TD. Okay? But everything else is multiplied by the 1 minus TD in the second period as well, because you're paying it back to shareholders in the form of a dividend. So notice that there's both a 1 minus TC and a 1 minus TD applying to the corporate earnings. That's what's called the double taxation of corporate income, and a lot of people complain about that. Now, my view is that the fact that there are actually two taxes is irrelevant, right? I mean, if there are two or there's one, what matters is the net rate. And so what people are actually complaining about, I think, is that the tax rate ends up being quite high, because if you have a 30% corporate tax rate and on top of that a 40% dividend tax rate, the investor ends up getting very little of the money back at the end of the day. Okay. Okay, so is that clear? All right, so everything we do is basically going to be working with that objective function. So let's start with the no tax benchmark, where the tau C and the tau D are equal to 0. So then you can immediately see, if you do the algebra, but it's very intuitive, that you're going to invest up to the point where the marginal return to investment equals the interest rate on the bond. So you're the firm owner, maximizing the value of the firm on behalf of the shareholders. Think about, you've got $1. You can put it in your company and generate 3 cents of profit, or you can put it in the bond and get a fixed interest rate of 5%. You're going to put the money in the bond, right? And so you're going to do that up to the point where the marginal rate of return on your investment equals the fixed rate of return on the bond. Okay? Now, in order to characterize the behavior of firms with taxes, it's going to be useful to divide firms into two types. Firms that have a lot of cash, so think of Microsoft, and those are firms, we'll come back to this, that are called new view firms. It's the theory that describes these firms is called the new view. These firms have cash holdings such that the marginal return to investment, if they invested all the cash they had, is below the interest rate. So what does that mean? A firm like Microsoft, their marginal return to investing all the money they have is plausibly, below the outside option that they have. So that means that they're not really that interested in raising new equity, because they already have enough money to invest whatever they want. Okay. Then you have a different set of firms, which I think of like in the current environment, like Twitter, that wants to have an IPO, wants to issue shares. They have X such that the marginal product of investment, if they just invest the cash they have, is higher than the interest rate. And that's why they want to issue equity, right? They want to get more money so they can expand their business. So we're going to see that the effects of taxes on these two types of firms are going to be extremely different. So let's start with the new view cash-rich firms. As I was saying, the marginal value of issuing equity is going to be negative, strictly negative for a cash-rich firm, because even the pre-tax return on investment is below the interest rate. So you already don't have anything to do with your $50 billion. There's no point in trying to raise an extra billion. So it immediately follows that the optimal equity issuance is going to be 0, and the firm is just going to split its cash between dividends and investment. And what rule is the firm going to follow? If you maximize that objective function, you're going to see that at the optimum, you're going to set the marginal return to investment times 1 minus the corporate tax rate equal to the interest rate. So why is that? Same logic as before. You set marginal returns equal to the value of the outside option. But now the marginal return has fallen because you've got to give part of the money to the government, right? And so that's why you end up investing less. So the consequence of that is that a higher corporate tax rate reduces investment under the new view model for firms that have a lot of cash. If we raise tax rates on Microsoft, they're going to choose to invest less. That's intuitive. Now, what you'll notice when you look at this first order condition, and this is the critical insight of Alan Auerbach and others, is that tau d, the dividend tax does not appear here, right? And so what that implies is that changes in the dividend tax rate actually have no effects on dividends, on dividend payments, or on investment behavior. And this is a famous result of Auerbach, David Bradford, and Mervyn King in the late 70s, early 80s. And this is really important because it says that corporate taxation is very different from dividend taxation. So you might have thought initially when you just look at this profit function, I've got to give more money to the government when dividend tax rates are high, and I've got to give more money to the government when corporate tax rates are high. So I think one intuition you might have had is if any of these tax rates are high, we're going to end up distorting the amount firms invest, and that creates an efficiency cost. But there's a critical difference between the dividend tax and the corporate tax. Yep. No, there's equity. Think about the equity being issued in some previous period, right? There's no new equity issuance. Yeah. Yeah. Okay, so dividend taxes have no impact on investment or dividend payments. So why is that? So first of all, let's see this mathematically. So what's going on is that the 1 minus tau d appears both in the first period and in the second period. And if you're not issuing any equity at all, you can just factor out the 1 minus tau d completely. So it's like I can either maximize my profits or I can maximize 1 minus tau d times my profits. So maximizing my profits or maximizing 50% of my profits, I'm going to end up doing exactly the same thing, right? Because it ends up factoring out completely. So what's the economic intuition for this? If I invest $1 and pay you dividends tomorrow, I end up giving you a return that is 1 minus tau d times 1 minus tau c times the marginal return on that additional dollar of investment. So it is true that that return is lower when dividend tax rates are high. But critically, if I gave you the dollar today, giving you the dollar today would also give you a smaller return if the dividend tax rate is high. So the relative price of investing and giving you money tomorrow versus giving you money today is completely unaffected by the dividend tax rate. The reason is either way I've got to pay, the money's stuck in the firm and I've got to pay the dividend tax either way, right? So I'm not going to avoid paying the dividend tax by giving you the money today instead of tomorrow. Whereas the corporate tax, I am going to avoid it by giving you the money today because the corporate tax is only levied on extra profits that I generate. So the corporate tax creates an incentive for me to not invest and pay the money back to the investors, whereas the dividend tax, once the money is within the firm, this new view is sometimes called the trapped equity view. Once you've got the money within the firm, you've got to pay dividend taxes either way, and that is, and so as a result, it doesn't make any difference what the dividend tax rate is for how much you invest. Okay? So why is this so important? Because it says that we can have high dividend taxes without distorting firm behavior. And dividend taxes are typically going to be paid by very rich people because the people who own shares tend to be quite wealthy. And so this can potentially be a great redistributive tool. And so this continues to be and was a really important political issue because Bush cut dividend tax rates dramatically in 2003. And in the Auerbach view of the world, that's just a transfer to rich people. And in competing views, which I'll talk about next, that might actually have been a good thing from an efficiency perspective. Yeah. Yes, that is captured by the next scenario that I'm going to talk about, okay? So it's a good question. Your intuition's right, but remember I've started from an assumption where these are firms with a lot of cash who do not need to issue equity, right? So they've already raised a lot of cash. They're not interested in issuing equity, and I'm thinking about the effect of dividend taxes for them. And that's exactly what shuts down the channel you're talking about. Yeah, Nathan? Yes, that's right. But from the current perspective of take a cross-section of firms, and suppose I just cut dividend tax rates, right? And they pay dividends. The direct incidence of that, of course, like various wage rates might change, and God knows what else might happen in general equilibrium. But the direct incidence of it is going to be on high income people. I think that view is correct. Okay, so now you guys are asking the right question about where did the money actually come from, right? So there's got to be, firms must have raised the money from somewhere to begin with. So this is what's called the old view, all right? Where for firms that are cash constrained, think of people having an IPO now, the pre-tax return on investment is above the interest rate, and so the marginal value of paying dividends is going to be 0, right? If you're trying to actually get money into the firm, you're not going to pay any dividends. So you're going to have D equals 0, and you're going to invest all the money that you have. So investment is going to be the cash you had before, plus E, your new equity issuance. So the optimal equity issue now is going to satisfy this condition, where same interest rate on the right-hand side, which is the opportunity cost of capital, and same marginal return, but now it's multiplied by both the corporate tax and the dividend tax, all right? And this, I think, reflects the logic you're talking about, that if I'm putting the money into the firm, my outside option is not to invest it. So I can either earn an interest rate of R outside, or I can give you $1, and you can pay me back a dividend, which is going to be 1 minus tau D times 1 minus tau C times the returns that you generate. So here, you're going to invest to the point where the net of tax return, taking the dividend tax into account, equals the interest rate. And so obviously it follows from that that equity issuance and investment are both going to fall with the tax, with both the dividend and the corporate tax rate, right? And so this is the Paterba, Summers, Feldstein view, that dividend tax cuts, that's the intellectual background for the Bush tax cut. Dividend tax cuts stimulate equity issues and investment and dividend payouts in the first period, so you can boost the economy by cutting dividend tax rates. So tau D here does not factor out of the value function because the marginal investment is being financed from external capital. So the fundamental difference is, what is the marginal source of capital? Is it internal funds or is it external funds? Okay. Now, so you see, you get very different views from these two models, and they're going to have very different implications for the efficiency cost of these two taxes. And so what I'll pick up in the next lecture is how we test between these two competing theories.